Our next guest, by the way, predicted a correction in stocks just a few weeks ago on this network. And he's joining us now, Tony Dwyer, Chief Market Strategist at Cannacord Genuity. Tony, very good afternoon to you.
Good afternoon, Wolf. Great to be here. Thanks for the invite.
So what do you make of the pullback? And to throw in, A, congratulations, but B, to caveat it, we've had quite a good level of support over the last couple of days. Are you surprised to see that?
Well, I got to tell you, Wolf, the whole reason for the pullback wasn't fundamental. You know, I love to say that corrections only seem natural, normal, and healthy until you actually get them. You know, when you're up 20% and there's 58% bulls and investor intelligence newsletter writers, the market's historically overbought and it's all good, people love to say, oh, I think it's going to correct and I'll buy that correction. And by definition, when you begin to correct, it's because there was too many buyers already, and you find a fundamental reason. This was a market looking for an excuse, and there's so many good excuses, but ultimately, I still think they're just excuses. And honestly, the drop in interest rates without an inversion of the 210 curve is extraordinarily stimulative. So the whole bull story that we had in the first half of the year, we agreed with the bears, was the economy was going to slow, takes the Fed out of the game. The whole bull story to get to our 33.50 in 2020 is a reacceleration because of these lower rates.
What is happening with earnings estimates as all of this global volatility and escalation in the trade war continues?
Sarah, we do these Mythbuster pieces, and we did one on the earnings per share revision, and we called it an earnings revision Mythbuster. Everybody is saying the out-year earnings estimate is too high, and when it comes down, it's going to lead to a multiple compression. I'm currently at 176 for S&P operating earnings next year. The street's at 184, and I'm looking for a multiple expansion. That sounds insane. Then if you actually look at the data, the only 2 years this cycle where you've seen a multiple compression and a down performance has been when you've had upward earnings revision, 2011 and 2018. It's all about interest rates and what is not just happening at the Fed level, but what's happening in the market rates.
Tony, now that we got this shakeout, whatever we want to call it, 5 to 6%, depending on the index, what are you looking for tactically to say, okay, it's run its course?
Okay, so Mike, as you know, I have 4 key tactical indicators I look at. One is the percentage of stocks above the 10 and 50-day moving average. It has to get to where 90% are below the 10-day moving average. You can check that box. The VIX has to get above 20. Check that box. What you haven't checked is that the weekly stochastic indicator, the intermediate term indicators, typically what you get is you kind of get this feeling like, wow, that was too fast. I'm not going to give up yet. You get what we've gotten in the last couple of days, some stability and a little bit of a bounce. Volatility has spiked. So what should happen now in our view is you get maybe another up day or two, and then you go down and test that recent low on lower VIX. So in other words, you have lower volatility, but you have this drift lower in stocks. And I think that's going to have set the stage for that next leg higher. But again, it just comes down to relieving some of these intermediate term overboughts.